Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Broadcom.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Let's do it. The core investment thesis here. What really makes this company, at the crossroads of chips and software, such a hot topic right now?
The thesis is actually pretty straightforward. It's that this company is an essential provider, think picks and shovels, for the entire AI build-out.
Right.
It has two huge and very profitable arms. You've got the high-end semiconductors, which is where all the explosive AI growth is happening right now. And then you have this incredibly sticky infrastructure software business.
And that combination just generates a ton of cash.
A ton. It's what you'd call a true cash flow compounder.
Okay, let's put some numbers on that because the scale is
Yeah.
Well, it's just breathtaking. The headline figures are huge.
They are.
For fiscal year 2025, you're looking at a net revenue of $63.9 billion. That's up, 24% year over year?
And if you zoom in on the latest quarter, it's even more impressive.
Right. A record $18 billion in Q4, up 28%. I mean, that's not just a normal uptick, that's acceleration.
It is, and we can pinpoint exactly where that acceleration is coming from. It is, without a doubt, the AI engine.
So it's not just the whole semiconductor market lifting up.
No, not at all. I mean, the whole segment was strong, up 34% in Q4. But the AI-specific revenue, that grew a staggering 74% year over year in that same quarter.
74%.
This is a company that has strategically positioned itself to capture the massive spending from the hyperscalers.
And just for anyone who's a bit newer to this, when we say hyperscalers, we're talking about the giants, right? The big cloud companies, Google, Amazon, Microsoft, the ones actually building these huge AI data centers.
Exactly. They're the ones writing the checks. And that spending is flowing directly to the bottom line. The earnings power is just incredible. The GAAP net income went from $5.9 billion to $23.1 billion.
That's a jump of almost 300% year over year, which is, almost unbelievable. It raises the question for you as an investor, how much of that is real sustainable profit versus just a one-time accounting thing?
That's the crucial question to ask, and you see the answer when you look at the non-GAAP numbers.
Which analysts tend to prefer because they smooth out things like acquisition costs.
Exactly. So the non-GAAP net income rose 42%. Still fantastic, but not 300%. Yeah. That huge GAAP number is mostly from integrating the VMware acquisition. It's an accounting spike.
So that 42% non-GAAP growth is the number to watch. It tells you the underlying business is scaling its earning power incredibly fast. This is real, profitable growth.
And that profitability brings us to the margins, which might be the most impressive metric of all.
We're not just looking for growth, but efficient growth.
And this is as efficient as it gets. For the full fiscal year, adjusted EBITDA hit a record $43 billion. That works out to an adjusted EBITDA margin of around 67%.
67%. Just think about that. For every dollar of revenue, 67 cents is flowing through to EBITDA. For a company that makes hardware, that is just staggering.
It is.
How are they even doing that while they're integrating a massive company like VMware and ramping up chip production? Usually, that kind of scaling puts pressure on margins.
It normally would. But they have two things going for them. First, their M&A playbook is it's masterful. They buy these mature, profitable companies and just immediately find ways to cut costs and boost efficiency.
And second,
the chips they sell are not commodities. They're extremely high-value custom AI accelerators and next-gen switches. These are foundational building blocks for the cloud giants, and they command very high margins.
And management seems to think this is sustainable. They're guiding for Q1 of fiscal 26 to hit $19.1 billion in revenue. And they're sticking to that 67% margin target. That's a big statement.
An even bigger statement is their guidance for the AI segment specifically. They expect Q1 AI semiconductor revenue to double year over year.
Double to $8.2 billion. And this isn't just a forecast. They say it's anchored in firm orders for their custom AI chips and their Ethernet switches.
Wow. Okay, so that moves us from earnings to just raw financial strength, a cash flow machine.
Right. All this profit has to turn into actual cash. And it does. Free cash flow for fiscal 25 was $26.9 billion. Yeah. The conversion rate is what analysts call extraordinary. They are incredibly good at turning paper profits into hard cash.
So what are they doing with all that cash? Using it very strategically. They ended the quarter with over $16 billion in the bank. They paid out over $11 billion in dividends, keeping up that tradition of dividend growth. And importantly, they're paying down debt. $18.5 billion in debt was paid down in fiscal 25.
So they're growing like a startup, rewarding shareholders like a blue chip, and strengthening the balance sheet all at the same time.
It's a very balanced and, frankly, defensive way to manage their capital.
The financials look like a fortress, but that kind of success, it attracts a lot of competition. They're trading at a premium valuation, so they need a really strong, defensible moat. Why can't a competitor just come in and take that share?
The moat is built on two things that work together: deep, deep intellectual property and customer relationships that are almost impossible to break.
Let's start with the IP, the custom silicon.
Right. These AI accelerators are not off-the-shelf parts. They are co-designed from the ground up with their hyperscaler customers.
So they're building a totally unique engine, say, just for Google's specific needs.
Precisely. And once Google or Meta or whoever builds their entire software stack and network architecture around that custom chip, switching to a competitor becomes incredibly difficult. It's costly, it's time-consuming, it's risky. That locks them in for years.
And it's not just the processing chips, right?
Yeah.
All those GPUs need to talk to each other at incredibly high speeds.
And that's their other key advantage. They are a leader in the high-speed networking that ties all these AI clusters together. We're talking switch silicon, SerDes, Ethernet controllers, NICs. You need their tech to get the low latency that AI demands. Their control over the Ethernet switch roadmap is a huge advantage.
Okay, so that's the hardware moat. Let's talk about the other pillar, the one that maybe gets less attention.
Yeah.
The software business.
Right, the infrastructure software segment. It provides this incredible predictability. It brought in $6.9 billion in Q4, growing at a very solid 19%. These are mission-critical products from acquisitions like VMware. Companies can't just turn them off.
So that's the buffer. If chip spending slows down in a recession, this revenue keeps coming in.
Exactly. Chip sales are CapEx-driven. They can be volatile, but the software revenue is based on multi-year recurring subscription contracts. It's a reliable, high-margin revenue floor that protects against the swings in the chip market.
And finally, there's the execution. They've proven they can do this over and over.
Absolutely. The M&A playbook is a core asset. Seeing that huge profit jump right after the VMware deal closed proves they can integrate these massive companies, pull out costs, and keep the innovation engine running. Management discipline is a key part of the whole story.
Okay, so we have a pretty clear picture of the bull case. Growth, margins, moat. But no investment is risk-free. What's the biggest thing that could go wrong here?
The biggest risk is, without a doubt, spending volatility. Their fortunes are tied to a very small number of gigantic customers.
The hyperscalers again?
If those hyperscalers decide to tap the brakes on their AI spending, maybe because of a recession, or maybe they just start questioning the ROI of these massive projects, then that doubling of AI revenue could slow down very, very quickly.
And with a stock priced for perfection, any slowdown would be painful.
It would lead to what we call valuation compression. The market is paying a premium multiple for that explosive growth. If the growth disappoints, that multiple gets stripped away and the stock could pull back significantly. That's the main risk you have to watch.
Are there any defenses against that risk?
There are. First, like we discussed, the revenue is anchored in those custom embedded solutions and the stable recurring software contracts. That provides a cushion. And second, if you look at the technical picture, there are some interesting signs.
What are you seeing?
Analysts are tracking what they call whale alerts. It's institutional options activity.
Big money making big bets.
Right. It shows large, sophisticated investors are actively positioning themselves. They seem to be using any weakness, any pullback as an opportunity to get in.
So the smart money sees these dips as a buying opportunity, not a reason to panic.
That seems to be the consensus. The recent trading pattern, where the stock moves up and then trades sideways for a bit, is viewed as a bullish consolidation. It suggests ongoing accumulation of the stock by large funds.
So what are the key events we should be watching for over the next few months? What are the catalysts?
All eyes are on one thing: the Q1 fiscal 26 results. Management set a very high bar. They need to hit that $19.1 billion in revenue and, most importantly, confirm that AI revenue actually doubled to $8.2 billion.
If they hit those numbers, the thesis is validated.
It's validated in a big way. We also need to listen to what they say at tech conferences about the order pipeline for the rest of the year.
And of course, the broader environment helps. We're still in the early innings of this massive AI spending cycle. Plus, if interest rates start to come down, that could boost valuations for all profitable growth leaders like this.
So if you put it all together, the final thesis is that this company is a truly mission-critical AI infrastructure leader. It has a fortress balance sheet, a deep moat from its custom silicon and sticky software, and it produces an incredible amount of cash.
Making it a compelling AI compounder for the next several years.
That's the argument.
That's a powerful one. Here's a final thought for you to consider. The fact that their custom chips and software are so deeply embedded in the cloud's architecture. It suggests this AI spending boom isn't just a temporary cycle that will fade away.
More of a permanent shift.
Exactly. It feels less like a short-term surge and more like a permanent structural change in how all these massive companies build their entire digital foundation for the future.
A fascinating point to end on. Thanks for breaking this all down with us today. Remember to subscribe and stay tuned for our next analysis.